Hello, everyone, and welcome back to another episode of Tax Thursdays brought to you by Smart Counsel. I'm your host, DDQ, here with Smart Counsel's tax resident attorney, Dionne Kellier. Happy Tax Thursday,
Happy
Dionne.
Tax Thursday, Dee Dee. How are you?
I am doing well. How's your week
My
been?
week has been great. Yesterday we celebrated the 1 year anniversary of Smart Counsel. Woo-hoo. All right.
1 year already.
1 year down, 700 years to go.
Right? It's crazy how fast a year can go by. Like, I just remember when we were, just starting everything.
When we
So
were
that's exciting.
transitioning.
Right, exactly. So congratulations to Smart Counsel for 1 year anniversary. Many more to come.
Thank you.
If you are new here, Smart Counsel is a woman-owned, minority-owned boutique law firm. You can visit our website at www.smart-counsel.com to learn more about our attorneys and practice areas. On today's episode, we will be discussing how a new member of your family, aka a baby, can affect your taxes. So, Dionne, my first question is, do taxes start for a baby when they're in the womb or when they are earthside?
When they are earthside. So, step one, find out you're pregnant. Everything up until you have that baby is on you. That's how the world works, right? So until that baby is delivered, then it's on you. But once you have the birth and it's a blessed event, then we have to do the important stuff. So first you have to file a social security number. So like how this topic came up, everybody has changes in life and different things happen. And, we've talked about death. Now we're going to talk about life, the bringing in of a new life. So the birth of a child is not just a blessed event. It's the beginning of a whole new set of tax breaks for your family. So the first thing that you need to do is you need to file for a social security number to be able to claim your child as a dependent. And if you fail to report the number for each dependent, the social security number, it triggers up to a $50 fine and it ties up your refund. I mean, is it fatal? Can you go to jail for it? No, you can't go to jail for it, but you're going to want to start taking advantage of the benefits as soon as possible, right? And so you can request a social security card for your newborn at the hospital at the same time you apply for the birth certificate. And if you don't, it's typically more of a hassle. And you will need to file that form SS5, that SS-5 with the Social Security Administration. But like you kind of get, when you have the baby, so when my best friend had, so this is so many years ago, aging myself, but my best friend, when she had her son Tristan, so he's like the first baby of all of us, and like he's gonna be 18 in November. I was in the hospital with her. So my other best friend, the one that passed, like she held her leg, but I can't do any of that. I was there after, and I was there for when like they taught us how to wrap him, and when they snipped him up and like all kinds of stuff, and they give you like all this information, all this paperwork, everything that you need to do, like even when they do the little footprint, and like it's so it was, that is the most involved. Like even my sister had a baby, I wasn't there for that part. I got to my sister like the day after she got out of the hospital, and then my nieces and my other niece and nephew, when they were born, like I wasn't in the full process. Like I saw them when they were home with the packet, but for my best friend Monique in the hospital, and they're like, if this is how you wrap the baby, and we're like, oh.
That is intimidating, and then to get kind of like all that thrown at you after giving birth.
And at the hospital, right? They see this all the time. Like for you, your baby is like this little piece of glass, right? Like you're like, oh my God. At the hospital, they see it all the time. They just smack that, and the baby's head is going.
On to the next one.
Right. Babies are resilient. So, okay. So I say that from a side. They give you a full packet with everything. So, if you, let's see, okay, so your child has to have lived with you for more than half the year in order to be able to claim them. But the time that you spent in the hospital with the child doesn't count against you. So like say that you had to, I don't know, say something happens and then the mother had to stay in the hospital with the child for like 3 months, 2 months, a week, 7 years. Oh, no, not 7 years, but you know what I mean? It doesn't matter. Right. It still counts as the time that the child lived with you. So first things first, you were a single person or you're married, but you guys don't have any kids, and now you have kids. What's the first thing that you get? So the American Rescue Plan that was passed in like March of 2021, it raised the maximum child tax credit to $3,600 as opposed to the $2,000. So it's $3,600 for qualifying children under the age of 6 and $3,000 per child for qualifying children ages 6 through 17. And you only can claim 3, right? Up to 3 children, that's the maximum. So 36 times 3 or 3,000 times 3 or a combination of any of it. And let's see, the child tax credit changes for 2021. They had the lower income. Anything for 2021 is still referring to this year because nothing has changed. Families that do not qualify for the credit using the income limits are still eligible for the $2,000 credit. So that means that basically if you're making above, and I have the numbers, probably I didn't pull it off the child tax credit, but I want to say it's above 400,000, then you start to phase out, you just get the lesser of whatever the phase out number is, and there's a formula for everything. In addition, the entire credit is fully refundable. So that means that even if you don't owe taxes, you can get the money back. So a child tax credit is a fully refundable credit, right? And the difference between a credit and a deduction is this. If you have a deduction, right, say that you make $1,000 and you have a deduction, then that $1,000 less whatever the deduction is and whatever that number that's at the bottom. So say that we're going to use $100. So you make $1,000, you have a deduction of $100. Now you will only be taxed on $900. Whereas a credit is you make $1,000, your tax on $1,000 say is $100 or say is $50, but you have a tax credit for $100, then you don't owe the IRS anything and you get back $50. Make sense?
Yeah, that definitely makes sense. Okay.
Perfect.
Credit and deductions.
Right. So that's the difference. Oh, okay. And I do have the phase out information. So it begins to the full child tax credit. It begins to disappear when incomes rise above $400,000 on joint returns and $200,000 on single and head of household returns. And yeah, so that's that part. And also, you'd have to cut back from withholding on your paycheck so that because the IRS, so I'll say this, recently, starting in 2020 tax year for sure, the IRS doesn't necessarily want to give you like the money back, right? So they don't want to give you $3,600 if you're over withholding. So they want you to cut back on your withholding. So you're either withholding the proper amount or a little bit over or a little bit under. So the IRS doesn't have to pay you $3,600. I mean, that's just the bottom line of that.
Right.
And so let's see, filing status. If you're married, having a child won't affect your filing status. But if you're single, it will affect your filing status because you're going to go from single to head of household. And if you're not married, and this is something that I've seen in doing tax resolution, if you're not married, no matter what the situation is, so there's 2 things. If you're not married, in Florida for sure, the child is going to be presumed to, the mother is going to be the custodial parent. That's number 1. So the father has to almost, I wouldn't say fight for rights, but he's going to be second in line. And if you are not married, and I don't care if you're together for 44 years and you live in Florida, in a state that does not recognize common law marriage, if you are not married, you cannot file as married filing jointly. You cannot file as anything other than single until you're married. Or you can file as head of household, but you cannot file married if you're not married, right? If you act like you're married, you're still not married. And even married, even if you're in a common law state, I don't even think IRS-wise you can file married filing jointly. I feel like it's a little bit more complicated, but I'll probably look into that because I don't think so. I think that, you have to be married. You're on your state side, it'll be a community property or a common law situation, but federally, you are a single person. So, and the penalties for that, huge.
Yeah, that'd be interesting to know because I know Colorado does have that common law. I know for state you can, but I'd be interested to know about federally.
I'm gonna look it up, and I'll have the answer for the next, just to follow up with it. But yeah, I'm gonna look it up. But I almost want to say stateside, yes. Federally, they're like no.
Right. You guys are married,
so
get married.
All right. So then now let's go to the next benefit: earned income tax credit. So for a couple without children, the chance to claim the earned income tax credit disappears when a joint return exceeds $27,380 for tax year 2021. And if you're single, it disappears at $21,430. But when you have children, it goes up, right? So if you have one child and you are married, you are able to make $48,108. And the most that you can make is, if you have three or more children, a joint couple can make $57,414 and still qualify for the earned income tax credit. But if you are single, the most that you can make, and you have to have three or more children, is $51,464. So $51,000, is that a little bit of money? It's not a little bit of money. I mean, well, maybe now with the gas prices, it's a little bit of money.
But, groceries.
Right, groceries. Oh my goodness. I watched this YouTube video that said that our meat products are going to go up because animal feed that used to cost, I know this is an aside, but whatever, we talk about everything. Animal feed that used to cost $14 now costs $58. So we are about to see, in a few months, like chicken be like $16 a pound.
I'm not surprised. I mean, just going grocery shopping now, I see the difference in how much I'm spending and what I'm getting versus last year or even the begining of this year.
Right. And we know,
it's insane.
And we understand being a vegetarian, it saves you no money, right? Because if I am almost scared if meat is going up to $16 a pound, can you imagine what a head of lettuce is going to cost?
Yeah, exactly.
So ridiculous. But I mean, this is where we're at. So, all right. So, child care credit. If you paid someone to care for your child while you work, like a daycare center, you may be able to claim the child and dependent care credit on your federal income tax return. And it's based on your amount of earned income. And earned income meaning like you have to earn a positive dollar. If you don't have a positive dollar, you can't take advantage of the earned income tax credit or the child tax credit. All right. So it's based on your amount of earned income. It could be up to 35% of your qualifying child care expenses, up to a max expense of $3,000 for one child or $6,000 for two or more children. But when I hear these daycare prices, that $3,000, it's helpful, but it's not covering anything. So,
and they charge per kid at these days
per week. Yeah. The thing is, when I see the price, I was like, wow, that's a lot.
That's a lot of money. Yeah, I didn't know that until I had a couple friends have kids and tell me what they were dealing with, and I'm just like, oh my gosh, that sounds so stressful.
It is,
because you have to work.
You have to work, but I would pay anybody who takes care of a room full of toddlers. Yeah, they're great people, but I'll pay you for it because that's a job.
Right. Yeah. All day too.
All day. When I babysat for my sister, I had to, I was nannying for a little bit. And by the time 7:00 bedtime hit, I was so excited. My feet hurt. I washed dishes. I washed clothes. I'm doing everything.
Yeah.
So if I could get a few hours free, yeah, it's worth the price. So that's just my side. So, okay. Yeah. So if you pay for childcare that allows you to work, and earn income for the IRS to tax, you can earn a credit. Let's see. So the child care credit phases out when your adjusted gross income exceeds $125,000, whether you are married filing jointly or not. And then at $438,000, you do not get the credit. And in prior years, the phase out started when your adjusted gross income of $15,000 or less. So basically, if you make over $125,000, single or with someone, you're not going to get the child care credit. Period. Point blank.
Wow.
There's another way. There's a child care reimbursement account, and so there's a tax-friendly way. It's a child care reimbursement account that your job provides for you, and they're called flex plans, and it allows you to divert up to $10,500 a year of your salary into a special tax advantage account that you can tap into to pay for your child care bills. And money you run through this account avoids both federal and state income taxes, as well as Social Security and medical taxes. So that's basically if you have an IRA, it's like that. Mm-hmm. It's taking money off of the top, so that money is tax-free, but it's for a particular purpose. let's see, you can't use both the reimbursement account and the credit, but know this, if you're making over $125,000, you can't get the credit anyway, so you might as well just go
Right.
to the account. And let's see, but you can claim, so while the flex accounts can go up to 10,500 tax free, you're able to claim up to 16,000 of eligible expenses if you have two or more children. And although you can only sign up for a flex account during open enrollment in the fall, most companies allow you to make mid-year changes in response to certain life events, including the birth of a child.
That makes sense. I mean, I guess the a question that kind of leads up, and I know you're going to touch a little bit on this, is what about adopting a
That's
child?
literally my next slide. So there's a tax credit to help you offset the cost of adopting a child. And for 2021, the credit is worth as much as $14,660. And if you adopt a special needs child, you can claim the full credit even if your actual adoption costs are less. And that amount starts to phase out at 2016, $216,660 to $256,660. So if you make over 256,000, you're not going to get the adoption credit. But if you make up to 216,500, you can get the full adoption credit. But it's 14,600. But like, as we know with everything, it costs, the full cost of everything is a lot more than 14,600. But
Right.
this helps. But then we would have something like, say that you have a surrogate. It's different. You don't get any credits for that. That's
Oh,
just an
I didn't even think about
yeah,
that.
that's just an expense you have to eat. And I feel like the reasoning behind that is because, you know, um, surrogacy is expensive. And so if you can afford to hire a surrogate that you cannot pay, so when you hire a surrogate, you cannot pay somebody to have your baby. But what you can pay
Right.
for is their reasonable medical expenses and to make sure that they're having a very comfortable life,
Healthy.
because the government
Right.
doesn't want people to be able to pay for babies.
Right. Wow.
Yeah.
That's intense.
Super intense. And it's just, I learn a little bit more every day. And I when I was doing the when I was working at TurboTax and I did somebody's return, and they gave what the actual cost of adopting was, and it wasn't even, it was, I want to say it was a domestic adoption, and it was at least like 45,000. I mean, they got something, but it was like 45,000 just the process and getting approved and making sure your house is fine. And it is an expensive process, but the blessings that you're gonna get are gonna be so vast that you know
For sure. No, definitely. And so with kids, how at what age does this whole tax stop covering them? Is that at the age of 18 when they're a legal adult?
17. Yeah.
17.
So
Okay.
17, you can get up to $3,000 a month up for your 17-year-old. But this is so different from, because I know a lot of people kind of get concerned or confused with, like, you can claim your child that's in college up until the age of 23 or 24 on your tax return, but you cannot get this 3,000 once they hit the age of 17. After their 17th birthday, you can no longer get the $3,000 child care credit or whatever the number that they're going to change it to. But you
Right,
get other
right.
credits, right? Because now they're in college, and then you could get the American Opportunity Credit. There's other things, and I will discuss those. So there are so many. There. When you have kids, I mean, they're a good little bank. So, like, another thing is you can save for their college, right? So there's the 529 savings plan, and contributions to these plans are not deductible on your federal taxes, but the earnings grow tax free, and the payouts to the children are tax free if the money is used to pay for qualifying bills. And some states give residents a state tax deduction if they invest in their own state's 529 plan. And there's also to fund a Coverdell Education Savings Account, which is called the ESA account for your newborn. And it's up to $2,000 a year can go into the ESA account for each child. There's no deduction for deposits, but the earnings are tax free. So, I mean, at the end, while your money that you're putting in is taxed money, the money that they're taking out is tax free if it's used to pay qualified education expenses. But now hear this. So ESA money can pay for elementary and high school expenses, even like a computer or software, as well as for college costs. And the right to contribute, though, to an ESA account phases out once you hit 95,000 and you're single, or 190,000 on your joint return. There is a, you are there, and there are ways to fund a 529 account that would be very beneficial to the parents in the event that they are, they came into a windfall. And there are ways to fund these, but of course, if you come to me for tax planning, I can help you out with that.
Right. And that doesn't count towards homeschooling,
No,
right? Like this has to be a public or a private.
not even private. I'm gonna get to that.
Oh,
Yeah.
no way.
Okay. Yeah. We're gonna get to that. So there's another thing. You can have kid IRAs, and they're small investments. So when a child is young and they could grow to huge balances, when you have a kid IRA, the child must have earned the income from working, from a job or self-employment. It cannot come from gifts or investments. So you can't open it for like a newborn, but like as soon as your kid is like 13 and starts mowing the lawn or whatever, then you can open the kid IRA. And you should probably do the Roth IRA, because while they'll never hit the income limits, and it is taxed money going in, so now you don't have to worry about, like with the traditional IRA, when the money comes out, they have to pay tax on it.
Okay. Makes sense.
There's something else. It's called the kiddie tax, and due to the graduated nature of our federal income tax rates, with the higher tax rates on higher incomes, it creates opportunities. So people that have a lot of money, also the biggest tax offenders are people that have a lot of money, right? And another thing is, the two people that don't file tax returns are CPAs number one, lawyers number two. Who would have known? Just so you know. So people that have the information typically utilize it to their advantage, and it's unfortunate, but it is what it is. I didn't know that people have the choice to not file taxes until I started. You don't really have the choice to not file taxes. You just don't file the taxes, and then you let whatever happen. But yeah, so that I learned that, and I'll never be one of those people. The IRS gets paid before anybody. So
yeah.
Let's see. So when you have higher income, and sometimes you want to create opportunities and shift the income from like you to your child. The IRS says that for the first $1,100 of a child's unearned income, it's tax free, and then the next is taxed. The next $1,100 is taxed at the child's tax rate, and then any additional rate is going to be taxed at the parent's rate until that child turns 19. So basically, you cannot shift your money to your child and think that you're going to get a break because they have a lower tax rate than you.
Oh, okay. Yeah, that makes sense.
Right?
So it's kind of like trying to get away with something.
Exactly. And there's all these different tax planning is not illegal. So like, there are legal ways to do this type of thing, but tax planning is not illegal. So there's so many things I want to talk about. So all right. So there's a nanny tax, right? And if you lawfully hire someone to come into your home to help you care for your child, you become an employer in the eyes of the IRS, and you're going to have to, if you pay them more than $2,300, you are going to have to pay the federal withholding, like FICA, federal withholding, Social Security, and Medicare. So you become, and the person is going to have to fill out a W-9, and you're going to have to issue them a W-2.
That makes sense. You're paying them to do a job, right?
Exactly. But most people, they don't. A lot of people, and it's unfortunate, do not look at, jobs in the houses as jobs that are that require paperwork and require the things that a job outside of the house would require. And because if you don't pay people, especially with a W-2, I think we talked about this last week, they're not going to get their proper Social Security when it's time for them to retire. So they're there helping you raise your kid and do everything. And you're making it so that when it's time for them to retire, they're not going to have, their life could have been more comfortable because they could have claimed more income.
Exactly.
I'm going to do some miscellaneous stuff, and then I'm going to do the big one because I really want to talk about this. So The child and dependent care credit may be reduced if you receive tax-free dependent care benefits from your employer. Medical expenses can be deductible if they exceed 7.5% of your adjusted gross income. So if you make $100,000 a year, your medical expenses are deductible when they are over $7,500. So just look at it like that. For every $1,000, you have to make it has to be above 750 for it to be deductible, tax deductible when you itemize your deductions. And the out-of-pocket, so what's included, the out-of-pocket cost of the hospital stay to birth the baby, related care counts as medical expenses, also breast pumps, lactation supplies. And so, that most people don't know about this. I know women don't know about it, but most people don't know about that. Let's see, working taxpayers with a child can claim the credit for qualified deductions. You may qualify for the earned income tax credit. Gifts in money or property from friends, grandparents, and other relatives are income tax free to you and your child. You can participate in a qualified tuition program, which is the 529 plan. And now this is the last one that I wanted to talk about because I feel like this is a big one. So the $8,000 child tax credit that many parents don't know about. So most parents can receive from the tax credit, the most a parent can receive from the tax credit is $8,000. And it allows families to claim a credit worth of 50% of their child care expenses, which could be up to $16,000 for 2 or more kids. And so if you spent at least $16,000, or if you spent $16,000 or more on child care expenses in 2021, you can get back, or you're going to get back at least $8,000 from the IRS through the expanded tax credit. Prior to the American Rescue Plan, parents could only claim 35% of a maximum of $6,000 in child care expenses for 2 children, so that would have been $2,100. Parents with 1 child can claim the 50% of their child care expenses up to $8,000, so you don't have to have 2 kids to get the $8,000. And let's see. Oh, well, you can claim the credit of up to $8,000, but you'll only get $4,000. So if you have more than 1 kid, you could get up to $8,000, and if you have 1 kid, then you can get up to $4,000, but you're able to utilize that $8,000 or that $16,000 number. Let's see. Many parents didn't realize. So who's eligible? Parents and people with dependents who paid for the care of a qualifying individual in order to look for work during 2021. So in order to look for work, a qualifying individual can mean several things to the IRS. A child under 13 who's your dependent can make you a qualifying person. A spouse or a dependent of any age who can't care for themselves and who lives with you for more than 6 months of the year. And it's important, that second one is really important because like a lot of people are caring for their adult parents or, children with disabilities or siblings with disabilities or just somebody who cannot take care of themselves allows you to claim this credit. So if you have a child with a disability, there's no age limit. There's also some income limits on the tax credit similar to those in the child tax credit and stimulus. So the credit percentages is reduced by 1% for every $2,000 for people who earn more than $125,000. So if you earned $127,000, for example, you'd only be able to claim 49% of the credit. Families that earn more than $183,000 are capped at taking 20% of their child care expenses, but it's completely phased out for people that earn $428,000. And let's see, those are married filed separate. So the biggest thing. If you are married and you file separately, you cannot claim the child tax credit. You cannot claim the earned income tax credit. You can't claim the child care credit. You can't claim any of these credits, right? And the reason why the IRS feels this way is because if you're choosing to file separately, that means that combined your income will probably phase you out. So then if you're separated, you're trying to beat the IRS, but the IRS is kind of hip to that already. So can't do that.
So neither parent can file because they're filing married,
Exactly.
but joint separately, right?
Right. So if you do a married filing separately return, you cannot claim any of the credits that we've discussed.
Wow.
So you have to file jointly, or single, or head of household, and you can't be married and file head of household. Just so you know. Right.
Right. Exactly.
So it's either married filing jointly or married filing separately. I'll tell you what's not covered in that. Let's see. So overnight, okay, if you send your child to a private school, the tax agency notes that you cannot claim that expense under the child and dependent care credit, because that K-12 tuition is not considered is considered an educational expense, not a child care expense. But before and after school programs are eligible. It won't qualify if it's provided by relatives or dependents or spouse, relatives who are dependents or spouses. So like say that like your little sister also lives with you, you can't claim them as a dependent and then also pay, her as the caretaker and then deduct that. So you kind of have to make a choice. Let's see. If you paid for any childcare through this flexible spending, you won't be able to use those expenses to claim the credit. And basically you can't get it twice, right? You can't have it both ways. The IRS says that the parents must be working or looking for work to qualify, and parents are considered to be working during any month when they are a full-time student. And work can either be for an employer, for yourself and your own business or partnership, and it could be full-time or part-time, and it could be inside or outside the home. But the major caveat is that although the credit helps people looking for work, a taxpayer must have earned some income, so one positive dollar at least. And so if you look for work and you didn't find a job, you cannot claim any of the credits. So like, I don't know, go work at Starbucks or whatever. That's my dream job, by the way, is to be a barista. But like, go do that so you can get a positive dollar. And let's see, finally, and because it's aimed at helping working people, you must have spent the money on caring for the child or the dependents in order for you, the parent, to look for work. And people who pay for care for older dependents can claim the expenses such as adult daycare, and the care can be provided inside or outside the home. But you have to get either the social security number or the tax ID of the whoever's taking care of the child. Right. Day camps are eligible, but overnight camps are not eligible. And before and after school programs are eligible, and care provided by a relative who is not a dependent can qualify. And it could be any type of camp: summer camp, sports camp, swim camp, band camp, whatever it is.
Okay.
And here it is.
Wow. So takeaways is, once you know that you are expecting or you have someone, a baby coming into the world, into your family, start preparing, start thinking about these things, the different tax deductions, credits, how to prepare to kind of set up your child to do well once they are outside of that, I guess 0 to 17 age range.
Yes. So yes. So first thing first, you're going to have to get the social security number. However you feel about the government, in whatever way you feel about it, that child needs a social security number in order for you to not get fined for not giving them a social security number, and for them to be able to provide benefits to you and claim their own benefits in life. So that's that's another takeaway. Another thing that I really think is very important, and like my parents are immigrants, right? So like there's a lot of things that they didn't know that they learned later on in life. So now I have access to the information. I also feel like, getting a life insurance policy for your child is going to be like super beneficial to them, and a life insurance policy that will grow in value, not a term policy, but one that will grow in value. And I think like when they're under the age of 7, it can only be like up to $3,500, but of course work with a financial professional for that. But I feel like life insurance is key in this world, key to wealth, and key to just having it gives you a basis in life. So if you get a life insurance policy for even if you're 2-year-old, by the time they turn 18, if this is something that has growth in cash value, even if it made $7,000 in all that time, which that's a bad policy, right? Because it should have made much more. But if you're 18 and you have access to $7,000 that's tax free,
yeah,
it teaches you like so much, whereas like you're excited for $100, right?
Right. No, seriously though.
Yeah, so I do think like those are very key things to keep in mind, and to just kind of research and allow the paths of wealth to be able to transcend to your child. But the child still needs to like work for things, like as far as either get straight A's or get a job, or I really get straight A's, the job I don't really but like I don't know what it is, right? I don't have kids, so I don't know the answer. Right. But I know that building wealth, and when you don't have to worry about money, then you can focus on school or education or whatever it is that you want to do in life, because college is not for everybody, right? But like, just to kind of have your path in life. But I know that when money is the least of your concerns, you thrive so much better.
No, definitely. It's so true. A lot of people kind of step into the world with so much debt to begin with. And why
Exactly.
not, kind of turn that around, that stigmatism around, and have them be a little bit more prepared, even though it may not be a lot, but
Some
it's better than nothing.
Exactly, better than nothing. And I feel like, when kids kind of have that ability, like, I actually think they're better money managers, right, than somebody who has to like literally stretch a dollar. Stretching a
Yeah,
dollar is
for
hard.
sure. No, definitely. It is. Yeah.
So,
That's awesome. Well, thank you so much again, Dionne. This was really enlightening. I think a lot of us can walk away with some good pointers, some good tips, some things to look out for, whether we already have children or are planning to or are expecting one. So, thank you once again. And thank you, everyone, for joining us on another episode of Tax Thursday. Make sure you're following us on all of our social media platforms so you don't miss out on a future Tax Thursday episode. Go ahead and like this video and subscribe to our YouTube channel. So again, you don't miss out on anything. And if there is a topic you want to see on here, shoot us an email at attorney@smart-counsel.com, or you can DM us on Instagram.
perfect.
Until next time, we will see you guys
Have
next
a
week.
wonderful day.
You too.